Welcome back, everyone, to another episode of Ready, Aim, Retire, uh, the show where we talk about everything from growing your money to having an amazing retirement, the one you dreamed of, to leaving that legacy for the people you leave behind. I'm Rob Curvin, your host as normal, usual, always here, but I'm always also here with Tony Shore from Minnesota. So, Tony, how we doing today?
I'm doing great, Rob.
Okay.
Great to be here. Thank you so much for having me on your show.
Mm.
And it was great talking to your associate there, Chris, before the
Yeah.
show.
Chris is going to be
He,
on the show shortly. We'll
yeah,
be
he's
able
a
to
great guy.
We'll be able to razz him too, Tony. So you won't just pick on me. You'll be able to pick on Chris, which is anybody that can. Anytime I can have something deflected from me, I think that's a positive.
Oh, I don't give you too hard. I go pretty easy on you, Rob, on the
Yeah.
show. It's off air.
It's off air where you really did your deal.
I really rub it in.
Yeah. No.
Yeah, I mean, we could talk about the Bears, but whatever.
Hey,
I
we're on a
mean,
1-game winning streak.
yeah, that's
Yeah.
true.
I
Yeah.
bought a new hat. I bought
Did
a
you?
new
Good.
Bears hat.
Oh, you
Watch.
jumped on that bandwagon. They won a
Oh,
game. You're on the
yeah.
bandwagon. I
Yeah, I'm
love
like,
it.
these guys are the real deal now. Like I
I
hated
love
them
that.
the week before. I said that they were terrible the week before that, and now I'm like, oh, these guys are Super Bowl bound. Like just look at the pieces we have. We have everything.
Well, hey, we were talking a minute ago before the show about my trip to New Orleans, and
Yes,
that's
and
where
your
I was
favorite
last
food.
week. And I think New Orleans has the best food. I've done a lot of traveling in the U.S., at least the continental United States. I've been to most of the states here, and I believe New Orleans has the best food. That's my bottom line.
Right. Now, I did ask you this. You never answered off air. What's your favorite dish? You started talking about shrimp, and then you said, but I don't really like shrimp. So that
Well,
doesn't
I'm not a huge shrimp fan,
right.
but there I eat the shrimp. It's so good. They have barbecued shrimp. They have shrimp po' boys. They have a gumbo that's to die for. The beignets, of course, they're famous for.
Yeah,
Cafe du Monde, the beignets, they're just covered in a pile of powdered sugar,
I love that.
deep fried pastry.
Yeah.
What could go wrong there?
Right.
But my favorite meal of the day is breakfast, and they have literally the best breakfast place called, and we're not being paid to say this, it's just my opinion, the Ruby Slipper, and
No
it's
free
in the
ads,
French
folks. No free
Quarter.
ads. Okay, go ahead. The Ruby
Yeah,
Slipper.
the Ruby Slipper.
All right.
Order the eggs cachone, homemade biscuit, a homemade muffin with pulled pork on it. Then on
Okay.
top of that, an egg, and an egg made well. Usually they have a really good poached egg. And for those of you who say, I don't like eggs Benedict or poached eggs, put all that aside, forget about it. I'm not a big eggs Benedict guy until I had this. Then they put their own homemade sauce on it with some great
Is it like a
seasoning.
hollandaise sauce, or what is it?
It's like that, but it's not hollandaise. It's their own thing, and it's so good. It's called eggs cachone, but everything they sell there is great. I mean,
Yeah.
from the coffee to the fresh squeezed orange juice to that. And usually, if you go between the hours of 7 and 10:30, there's going to be a little bit of a wait. Don't worry about it. Don't even worry about it. They'll text you when your table's ready.
Okay.
It's well worth it. This time I went at like 11 a.m. and there was no wait, and there were plenty of open tables.
How long were you in New Orleans for?
4 days.
And how many times did you hit this place?
Twice. Yeah.
50%?
Two
Okay.
mornings. And I've been to New Orleans every year for the last 6 years, and there's a couple other places that are recommended for breakfast, and I've tried a couple of the other supposed top spots. Not even close. The
Wow.
Ruby Slipper. Yeah.
The Ruby Slipper, folks. You heard it here first. You heard it here
Hot
first.
tip. We're not supposed to give specific advice because
Right.
everybody's situation is different.
That's
But
true.
I believe that for all our listeners and viewers, Rob, the eggs cachone will set them free.
Okay. All right. And that is very specific advice, but I think we'll get away with it. Tony. That'll be
Sure.
fine.
How about you? Where have you been?
Where have I been?
Working mainly.
Yeah, I don't think I've been anywhere, Tony. In a couple weeks, I'm going to go to Omaha to see my daughter.
Oh,
so we're going to go watch. We're actually going to watch a couple Minnesota State hockey games. They're playing Omaha.
Oh, really?
Yeah, that's where
Go Gophers. Go Golden Gophers.
No, Minnesota State. They're
in Minnesota State. Oh,
Mankato.
Well. Oh, Mankato.
Yes. I know all the lingo.
They're a little bit of a laughing stock here in Minnesota. Mankato State.
They will be top 10 this year. I'm saying it
in hockey. Yeah.
Oh, yeah.
In hockey.
That's all I'm talking about.
Yeah.
You think I'm talking about moving there? No, I'm not moving to Mankato, the
You're not
college
talking about
town in the middle of
IQ
nowhere.
or other sports. You're talking about hockey. Yeah,
Yeah,
no, Mankato State, honestly, a great
yeah,
hockey team.
yeah, they're good.
Yeah.
They're good.
Yep. Will
So
you
that's
see
all I
Bill
got.
Altman while you're there, buddy of ours? I
It
know he's a
it's
fellow
possible.
financial guy.
Yeah, yeah. So sometimes I see him. It just depends on the schedule. So sometimes I see him, sometimes I don't. Um, Always fun to hang around Bill. He's a fun guy. So
Yeah.
so if I have time, I definitely like to carve it out. I just don't know really quite. If I'm going to be honest with everybody out there, I actually don't even know the schedule. I just know we're going.
Oh,
Natalie is in
sure.
charge of that, so she'll tell me when we're leaving. Tell me what we're doing.
It's a
She'll tell me
family
when we're
thing.
coming home.
You're
So
not going there for financial, powwows with Bill. You're going
no,
there for the fam. That's good.
right, right.
That's
But
good.
that's all I got in the immediate future
Good.
anyway, Tony. So it'll be good.
Good.
Yeah.
Well, hey, guess what? I don't know if you heard, Rob, the Fed cut interest rates.
They did, and then we're gonna talk about that today, Tony.
Okay.
Obviously, that's big news, right?
Yeah.
So what I wanna talk about today is more, all right, they cut interest rates. What does that mean for me, right? So, how does that affect the people listening out there, whatever part of life they're in, whether they're in, the accumulation phase or coming into retirement or full-blown retirement. Cutting interest rates affects everybody in different ways, depending on kind of life cycle, right? So to sum it up, so they cut interest rates by 0.25 of 1%. So they call that a quarter basis point. They did that on September 17th. The bigger thing, Tony, is everybody kind of knew that was coming. If it
Yeah.
didn't come, the market would have went down pretty heavily, right? So
I
they knew
think
that was going
so.
to come.
Yeah.
And what we listened for is we listened for the commentary, coming out of Jerome Powell, the Federal Reserve Chairman, and to see, all right, how many more are coming, and they kind of indicated that they're going to continue gradual cuts. They always say the word data dependent. Um, and when I think about data dependent, I don't know over the last few years, Tony, how um, the Federal Reserve, their main benchmark was inflation,
Yeah.
right? Like we went through that inflationary time where some of it year over year was 9%, 10%. So their main mandate for raising rates was to get inflation down. And
Right.
and their target rate, do you remember what their target rate was?
Wasn't it 2%?
2%, right. So their
Yeah.
target rate's 2%, and they were like, we're going to hold fast at 2% until we see a downward trend of 2%. We're not cutting rates. So they cut they cut about 1% last fall. The inflation rate stuck around pretty sticky around 2.5, 2.6, 2.7. And then we come into last week, right before they did this, and the inflation read was actually 2.9. So
It
you
went
ask
up.
yourself, wait a second, why would they cut rates when the inflation is going this way? From their indication and kind of how they've pivoted, they've changed their main target being inflation to unemployment. So what they look at, and folks, you got to understand what the Federal Reserve is trying to do is they're looking 6, 8, 10 months in advance. And you don't, for all the people that want them to cut interest rates, if they're cutting interest rates, that's telling you 6 months, 8 months, 10 months, they feel that there's going to be an issue. And if they cut rates, maybe they avoid this issue. And so far, they've been pretty darn good. Like when they had to raise rates for the first time in 2022 in 40 years, everyone thought, the recession meter it was going off the hook.
Yeah.
Like everyone's like,
The sky was falling. We're going to head into a major recession, just like 2008. We heard it all, right?
right, right. And everyone thought that. And
Yeah.
it made a lot of sense, right? You're just raising rates, raising rates, raising rates. And the market obviously didn't like that. Even the bond market was down 10, 12% in 2022, so there was nothing winning in
No.
2022. So they come out of that and, kind of just, we don't raise rates for a year. And then, last year in the fall, they decided we're going to, this is the time, right? Well, if you look around the world, several countries have been cutting interest rates for the last year and a half pretty heavily. Like you look at Canada, they've cut and cut and cut and cut. And when you're doing that, you're trying to hold off a recession. If you look at Canada's unemployment, it's skyrocketing. It's skyrocketing, and they've done all these cuts, and eventually you can't cut anymore. There's only so much white dry powder that you have that you can cut with, right? So I think he's done a fantastic job in that sense. I'm like, Tony, I'm not a political guy, so I could, I don't get pulled down in that minutia ever,
Sure.
as far as that. I just look at data. And when I look at data and I say, you know what? This guy's not only got us through 2022, 2023, great year, 2024, great year, 2025 so far seems like a pretty good year.
Yeah.
Um,
But he has been, I mean, part of it too might be, I'm just throwing this out there.
yeah,
There also has been some political pressure on the Fed to lower rates, a lot of pressure,
a
right?
lot of
From a
pressure.
lot of people.
Yeah,
I think from the political pressure has been great on them to lower rates, and that
mm,
may have been part of the reason we saw them change tax. But I think you're right. The Fed has said that they've shifted from it's the inflation metric we're using to, hey, we see something coming that really does necessitate, because before, when there was pressure to lower rates and they didn't, they
right.
proved that maybe that isn't affecting them. But they did look at the job numbers and they're like, okay, we probably need to lower rates, is what you're saying.
Yeah, that's exactly what I'm saying. So they pivoted to the if you looked at the last 9-10 months, unemployment has been steady at 4.1, 4.2%. So the last read just came in and it was 4.3%. And again, when you look at a full employment market, we're there still. 4.3 is still full. We forecasted at the beginning of the year that we thought at the end, by the end of 2025, we'd be at 4.5%. Still full employment. And what the Fed's trying to do is say, all right, what if it keeps ticking up? What if it goes 4.3, 4.4, 4.7, 5? Then there's a problem. So you have to get ahead of it. And what they're kind of telegraphing, I believe, is saying, you know what, in 6 months, 9 months, we may have an employment problem. So if we cut rates now, that helps, in several ways for a company. Companies are the same as me and you, Tony. We like to borrow money at a lower rate. And companies borrow money to expand and hire, right? And so if the rates are a little bit lower, maybe they don't lay off these people. Maybe they decide to grow instead. And that's kind of the thought process. So they've put this inflation number on the back burner, and
Sure.
most economists, or several economists, they have that inflation not staying at 2.9. They have it actually going up to as high as 3.2 over the next 6 months or so, right? So they seem to have tabled that. But from their perspective, I just think that they're getting ahead of something. And for individuals out there listening, what does it mean when they cut interest rates? Because they cut interest rates and everyone thinks the mortgage rates are going to, drop to the ground. They haven't. They cut them by a half a percentage point last September. Mortgage rates were at 7% that the day they cut. They finished at, I think, 7.1, 7.2. So over time, yes. Initially, no. And I think, when I look at stats, and I put some stats on the first time home buyers. So we have an epidemic in this country. Epidemic, maybe I shouldn't use the word epidemic, but there's a big problem with first time home buyers. So I went and did some digging and said, how has this changed over the years? So you have the 1980s, late 20s, it was the average age you bought a home. And then 90s to 2010, it moved up a little bit to 30 to 32. 2020, it was 33. And 2020 had very favorable borrowing rates, by the way. And now first time home buyers are 35 to 38 years old. So it's getting later and later, and you don't want to get to the point where nobody buys a home, because that's kind of the American dream. You buy a home, you build a family, and you build your legacy, and so on and so forth. So when you look at the clients that are in there that can't buy these homes, them lowering interest rates again, we're not going to see a 5% mortgage rate in the near term. But if they lower them gradually over the next 12 months, because I don't think it's anything quick. And if it is, folks, they see a problem. So it's kind of nice that they're stretching these things out. But in a year from now, Tony, if we saw them cut, like, say, a total of 1% over the next 12 months, you would then see mortgage rates at maybe 5.5, 5.75, and that's more doable, because home prices obviously over the last 20 years have gone like this, The COVID thing didn't help. They skyrocketed
No.
everything. You had houses going like this and mortgage rates going like this, which it was a perfect storm for if you're ready to sell your house, you did very well, and if you're buying a house or refinancing that period of time, you probably have a low payment, which kind of helps. And that's probably, part of why the economy has continued to grind higher,
Yeah.
the GDP just came in higher than expected this morning. For the second quarter, I think it was, again, I was walking by, I want to say 3.8 and they thought it was going to be 3.3. So it came in stronger as far as the economy, because there is a high percentage of people with these very low mortgage rates,
Yeah.
so we want to get the next, generation of people into homes with these low mortgage rates. So
Yeah. My son and his wife, my son's 26, and they're like, "Dad, we can't afford on our salaries and paying off our college debt to also buy a home."
right, you can't.
We don't know if we'll ever be able to afford to buy a home at this point. So a lot of his age group, that generation, is concerned about being able to afford a house. And the stats that you were talking about, just an FYI for our listeners out there, if they want to know where these stats come from, there's an article on the National Association of Realtors,
Mhm.
and it's called "First Time Homebuyers Shrink to a Historic Low of 24%."
Yeah.
Yeah, and so that's at nar.realtor, and there's no .com there, it's just nar.realtor. So, you can check that out. Just
Tony's
wanted to
always good
cite
with
the
the
source.
Yeah,
Yeah.
Tony's always good with that. That's why we keep him on. He's always good to make sure I'm not just spewing numbers out there,
Right.
making them up. But
Yep, nope, the numbers you're talking about are right there, and
yeah,
it is a crisis in this country, you're
right.
right.
And that's why those interest rates have to get adjusted down. And then the other people that, I would say the majority of our client base is in that either pre-retirement or fully retired, right? So they like high interest rates, Tony, because they're not buying a house.
Right.
They have very little credit card debt. They certainly don't have a student loan, so what they want is what? They want high rates on their CDs, their fixed annuities, their bank accounts, and
Yep.
they have, especially the very conservative ones and the savers, they've been rewarded heavily over the last, 12, 24 months, right? And
Oh, yeah, MYGAs, and CDs and MYGAs
yeah,
had really good rates, the
big
best
time.
they'd been in a long time, especially on the fixed index annuity and the MYGA, multi-year guarantee annuity, and even some CDs. Before that, when interest rates were near zero, the most you could get on a CD was like 1% if you were lucky.
That would be really lucky. Like, you would get
Yeah.
a lot of 0.35s, point
Yeah.
4.
Point
Uh,
point
right,
4,
and
and
you
that's
jump from
nothing,
that all the way
right? I
to
mean,
4 or 5, right? So you go all the way, all of a sudden,
to
this money that's
5.
sitting in the bank, you're making money on it, which they haven't been able to do.
You're
So,
actually you were actually able to keep up with inflation,
yeah,
when the interest rates were higher on the safer type accounts that had principal protection,
right.
right? And
Yeah,
so,
and that's
and
important.
as you get older, a lot more people have those types of accounts, right?
Right. Because they have the whatever their basket looks like, they have it, and they don't wanna lose it.
Right.
Right, so they can use a CD, for money that's just sitting in the bank that they know they're not using. They can use, like you said, a fixed annuity, whatever the vehicle is. Those principally protected vehicles were bearing high interest. We've seen those over the last 8 weeks, Tony, start to trickle down.
Yep.
Go to the bank now, it's not the same thing. The bank will start
No.
doing, those 7-month CDs or 13 months.
Yeah, I mean, a 7-month, "Hey, we'll give you a pretty decent rate that's
Right.
about at inflation, but it's only for 7 months, and then
And
you're
why do
gonna
you
have
think
to
they do that, Tony?
renegotiate."
That they do like a time frame of 7 months?
Because they know it's probably gonna go if they know it's gonna be lowered, they don't want you making more interest if they're not gonna be able to earn it on your
And
money.
you're right, and the other thing that happens is it's an odd time frame, so guess what you do, Tony? You forget about it. So
Oh,
then it
yeah, and so it
renews,
auto renews.
not only
My
renews after
That
7
happened
days.
with my dad. My
Yep,
dad had a
y
CD that he inherited from his father when my grandpa passed, and sure enough,
right,
that thing turned over, and I said, "Dad, we gotta go into the bank. You gotta go in and do this," and he didn't, and so then he's stuck with a CD making a lower rate.
totally, right, and that's kind of the
And it's
whole
always odd.
thing.
It's never a year. It's
No,
not. It's
13 months, 14 months, 7 months, 8 months.
eighteen,
It's
nine,
times that
7.
don't, comprehend it initially in your head. You
It's
think in
usually an
year.
odd number. It's
Yeah,
7 or 9,
yeah,
yeah, or 13. I mean, that's terrible. I always wondered why that was, and you just addressed it.
right. That's exactly what, because then you do the auto renew.
Yeah,
And then you're like, "Oh, geez, it auto renewed. Okay, I'll get it next time." And it's auto renewed for another weird time period where
yeah,
you're like, "I'm gonna really pay attention to this." You're away on a trip, you get busy, auto renew, and you'll see those things, especially, from the banking side, they're usually ahead of things, quicker as far as dropping rates. So you're gonna see those rates continue to drop, over
yeah.
the next 12 months,
You see a
and
direct impact. That's the only place you probably see an immediate or
yep,
pretty quick impact, relatively quick impact. When the Fed lowers or raises rates, the rates you make at a bank will change.
yeah, and
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 and it
they
changes quicker on the downside than it does on the up. Have you noticed that?
for
When
sure.
the Fed was raising interest rates, the CDs started ticking up.
Right.
But when they lower interest rates, oh, the full quarter is gonna be wiped out
Oh, yeah.
immediately.
Yeah,
Yeah,
you're right. That's a really good point, Tony, because, like, yeah, they always hit you on that side first, right? They don't
oh,
wanna
yeah.
give you
Yeah.
anything, but
No.
eventually they have to become competitive, and there's a bank
Yes.
out there offering 4, so we gotta do 4, and there's
Yep.
4.1, we gotta do 4.1, but coming down, they all don't care, they're coming down,
They
they're
wanna hit as low as possible, as
right,
immediately as
and they
possible.
know that the rates as they, even if they're gradual, and, we think there's probably at least 1 more rate cut this year, and then maybe 2 or 3 next year, and they're kinda going, "Okay, that 7-month CD is gonna be, we get a lower, okay, we're gonna be able to renew that thing instead of at 3.9, we might be at 3.1, that's great for us, maybe not for the consumer, but, that's kinda how they look at things, right? So
Yep.
so our clients, I would say the majority of them have been huge benefactors of this, and I also do believe, Tony, that there's a floor here, as far how low they're gonna go with dropping rates. So I still think that we come out of this after they, do the rate dropping cycle where savers are still going to be rewarded. They're not going to get 5% on a CD or, a fixed annuity or anything, but what they're going to get is they're going to get, something reasonable, like a 3%, which is probably right at inflation. It's going to be right
Yep.
at that inflation number. So instead of having the money sitting in the bank, and you're losing because inflation is, I told you 2.9, and we think it's going to go to, or we think, but most economists think it's going to be 3.1 or 3.2, and then it's going to probably retreat back down, right? But the money's sitting in the bank, not making anything, you're losing. You're losing. You have to look at it. You're losing 3%. You have to have that money working for you in some shape or capacity, whether that's in an investment account, whether that's, a bank CD, whether that's, a stable value or an annuity or something like that. It's got to be working for you. It does you no good on the sidelines, and
Nope.
especially with the inflation environment we're in, you're just losing. Like
Yeah.
everything goes up every month you look or go grocery shopping. It's just
Right.
higher. So
But everybody's situation is different, and Rob,
yeah.
you're not telling people that they shouldn't have some money that's liquid. You should always have cash
Oh
reserves that
yeah,
are
yeah, for
liquid,
sure, for
but
sure.
or at least fairly liquid. But if you have $100,000 that you haven't touched in a year and it's in a bank, an account that's making next to nothing, like a savings, even if it's interest bearing savings, and you're not going to need it for 12 months, put it in a MIGA,
Something.
put it in
Yeah,
something.
and at least some of it, Tony, right? Like, so you don't
Right.
like, because there's a reason that people have 100,000 sitting in a bank account, and the reason is psychologically that's their number. Like that's the number that they want to see, and it could
It
be
helps
100,
them
it could be
sleep well.
50. Yeah,
That sleep well at night might be worth it, right?
yeah, yeah, yeah. The refrigerator money, right? It could be, some people it could be 10 grand, but like you said, there's lots of people it's 100 grand, whatever that is. But you have to have some of it doing something. You still have to
Yeah.
have
That's
that.
a secret tip of the wealthy. A secret of the wealthy is, almost all their money is always working for them.
Right.
It's yeah, they don't have anything that's losing to inflation. I mean, they might have some cash reserves, but, the it's a small percentage compared to, they don't have big amounts of money sitting in savings accounts.
No, no, they have it doing something, right? Then
Right.
and for the folks out there listening, this is the time. We know, and if you've watched any TV or anything, that the rates are forecasted to continue to drop. So now is the time to kind of, maybe explore those CDs, maybe explore those fixed annuities or indexed annuities, whatever it happens to be, and explore them. Say, hey, what's the best rate I can get on this money right now, and at least get, locked in on a good rate for 2 years, 3 years, 5 years, whatever, whatever you're kind of looking for, because you want to stretch this thing out, because when you peek your head up again, the rates will be lower, and the offerings will be lower. So we're in a very unique environment right now that I think benefits the savers. And I think coming out of it, like I said, Tony, they will still be benefiting way more than the pre-interest rate hikes, where you're getting CDs and stuff for 0.35 or 0.45, or like
Yeah,
Tony
well, at
said,
one
maybe
point
it
it's
won't on
about zero, right? I
Oh,
mean, interest
sure.
rates basically bottomed out,
Yeah.
right?
So there was no, squeeze on the lemon, right? So
Right.
so if you're listening out there, I would encourage you to give someone a call, sit down with a banker, sit down with us, sit down with somebody, and see what your options are. Wherever you may be listening from, and if you want to sit down with us, Tony, the perfect segue right there. Give us a call at 630-780-1099. Again, 630-780-1099. Come on in. You can sit down with myself, part of our team, sit down and go through your situation and see what the options are. And you can also go on our website at apadvisorsgroup.com. Not only can you see a lot of good information, but geez, if you ever miss a show, Tony, they got the last, like, I think 4 or 5 up there. So
Oh, yeah.
for all you Tony and Rob groupies up there, you can just keep on listening and listening and listening, right? You have to go to YouTube. Just go to our website, But let me finish with this, Tony. Whether you're at the beginning of your journey, you're somebody that's in the 20s and the 30s, all the way to retirement, these interest rates affect everybody. And you have to kind of be cognizant of it, more of how does that affect me? Like I said, a new mortgage isn't affecting a lot of retirees. Some maybe that move to new spots, but for the most part, I'm painting with a big brush.
Right.
Doesn't affect them. And guess what? The CD rates don't affect that first time home buyer that much. They're in the accumulation. They're trying to grow their money, right? But for everybody out there listening, these rates will affect you in different ways. And it's good to get good advice and sit down with somebody that can explain where you're at in life and how these things are affecting you, because this is going to continue, I think, at least for the next 12 months.
Yeah, I think so as well. I think you're spot on. So great information for our listeners and viewers out there today. And again, I tell you what, give Rob and his staff there a call, 630-780-1099. That's 630-780-1099.
And Tony, if you're ever in New Orleans, where do you want to go to?
You want to go to the Ruby Slipper and have
The
the
Ruby Flipper.
eggs
Get
cachone.
there.
And for all you foodies out there, all right, that does it for today's episode of Ready, Aim, Retire with our host, Rob Curvin.